Welcome to the Success Blueprints podcast show, where today we are set to unlock the door to one of the most powerful tools for building wealth, the stock market. If you've ever wondered how to take that first step into the world of investing, you're in the right place. This episode, How to Start Investing in the Stock Market, a Beginner's Guide, is crafted specifically for those who are ready to embark on their financial journey but aren't quite sure where to begin. Whether you're looking to grow your savings, plan for your future, or simply expand your financial knowledge, this episode is your guide to understanding and navigating the stock market with confidence. We'll be breaking down complex concepts into digestible insights, ensuring you leave with a clear understanding of how to make your money work for you. Now, let's take a moment to consider the stock market itself, a dynamic and sometimes daunting world that plays a critical role in the global economy. It's not just a place where stocks and shares are bought and sold. It's a powerful mechanism that allows companies to grow and investors to build wealth over time. Understanding the stock market is essential for anyone looking to secure their financial future. From the bustling floors of Wall Street to the digital trading platforms accessible at your fingertips, the stock market offers a plethora of opportunities for those willing to learn and engage. By the end of this episode, you'll gain valuable insights into why the stock market is such a pivotal element in wealth creation and how you can harness its potential to your advantage. In our journey today, we will explore not just the basics, but also strategic approaches to investing that can set the foundation for your financial success. With sections like understanding the stock market and setting investment goals, we aim to equip you with the knowledge needed to make informed decisions. You'll learn how to identify promising companies, understand the significance of dividend-paying stocks, and monitor your portfolio effectively. But before we delve into these topics, here's an intriguing thought. Did you know that the stock market has been responsible for minting millionaires and transforming entire industries? Imagine the possibilities as you begin to understand and navigate this complex but rewarding territory. Prepare to be informed, inspired, and empowered as we kick off this episode of the Success Blueprints podcast show. The stock market is a multifaceted entity that plays a pivotal role in the global economy, serving as a platform where shares of publicly held companies are issued, bought, and sold. It acts as an indicator of the economic health of a country, reflecting the performance of its businesses and the confidence of its investors. The stock market operates through a network of exchanges, such as the New York Stock Exchange and NASDAQ, where brokers and traders buy and sell stocks. These exchanges are akin to a bustling marketplace, albeit one that operates both physically and digitally, facilitating transactions that range from small individual trades to massive institutional investments. Each transaction is a result of complex interactions involving supply and demand, investor sentiment, and broader economic trends. Understanding how the stock market functions can be likened to learning a new language, one that opens up a realm of possibilities for individual and institutional investors alike. As you become familiar with the terms and mechanics of stock trading, you gain insight into how wealth can be accumulated and how financial goals can be achieved through strategic investments. In contrast to stocks, which represent ownership in a company, there are various other investment vehicles available, each with its own characteristics and benefits. Stocks are typically considered growth investments, offering the potential for significant returns over time, albeit with higher risk. Bonds, for example, are debt securities that represent a loan made by an investor to a borrower, often a corporation or government, and are generally viewed as more stable, income-generating investments with lower risk compared to stocks. Mutual funds and exchange-traded funds, ETFs, pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets, providing diversification and professional management. Real estate investment trusts, REITs, offer exposure to the real estate market, allowing investors to earn income from property investments without directly owning physical properties. Each of these investment options has its own set of risks, returns, and time horizons, making it essential for investors to understand their individual characteristics and how they align with their personal financial goals. By recognizing the differences between these vehicles, investors can make informed decisions that align with their risk tolerance and investment objectives, paving the way for a diversified and balanced portfolio. Setting clear investment goals is a crucial step before diving into the world of investing. These goals serve as a roadmap, guiding your financial journey and helping you make informed decisions that align with your long-term aspirations. Defining your financial goals involves understanding what you hope to achieve through investing, whether it's building a retirement nest egg, saving for a child's education, buying a home, or simply growing your wealth. Each goal will have its own timeline and financial requirements, influencing the strategies and types of investments that are best suited to achieve them. By having clear objectives, you can create a structured investment plan that prioritizes your financial needs and aspirations, ensuring that your actions today contribute meaningfully to your future financial security. This approach not only provides clarity, but also instills discipline, helping you stay focused amidst the myriad of investment opportunities and market fluctuations that you will encounter. Understanding your risk tolerance and investment horizon is equally important in shaping your investment strategy. Risk tolerance refers to your ability and willingness to endure the fluctuations in the value of your investments. It is influenced by various factors, including your financial situation, investment experience, and emotional resilience to market volatility. A high-risk tolerance might lead you to allocate more of your portfolio to stocks, which, although volatile, offer the potential for higher returns. On the other hand, a lower risk tolerance might prompt a preference for more stable investments, such as bonds or fixed income assets. Your investment horizon, or the length of time you expect to hold an investment before taking the money out, also plays a critical role in determining your strategy. Longer horizons typically allow for more aggressive portfolios as they provide time to recover from market downturns, while shorter horizons might necessitate a more conservative approach to preserve capital. By aligning your investments with your risk tolerance and time horizon, you can create a balanced portfolio that not only seeks to achieve your financial goals, but also provides peace of mind as you navigate the ups and downs of the financial markets. Getting started with investing involves a series of steps that lay the foundation for your financial journey. One of the first and most crucial steps is opening a brokerage account, which acts as your gateway to buying and selling stocks, bonds, and other securities. The process of opening a brokerage account is generally straightforward, beginning with choosing a brokerage firm that aligns with your investment needs and preferences. These firms vary in terms of the services they offer, fees, account types, and the ease of use of their trading platforms. Types of accounts you might consider include individual brokerage accounts for personal trading or retirement accounts, such as an individual savings account, ISA, or self-invested personal pension, SIP, for tax-advantaged savings. It's important to understand the features and benefits of each account type to select one that best suits your financial situation and goals. Once your account is set up, you'll fund it with money to begin your investing journey. This initial setup phase is pivotal as it sets the stage for all your future investment activities, making it essential to approach this step with careful consideration and planning. Equally important is the role of initial research and education in making informed investment decisions. Before jumping into the market, taking the time to educate yourself about basic investment principles, market dynamics, and the specific assets you are considering can significantly enhance your investment outcomes. This involves understanding financial statements, analyzing market trends, and becoming familiar with different investment strategies. Resources such as books, financial news, online courses, and seminars can be immensely helpful in building your foundational knowledge. Additionally, staying informed about the economic landscape and geopolitical events can provide valuable context for your investment decisions. This continuous learning approach not only aids in selecting the right investments, but also equips you with the confidence to navigate the complexities of the market. By prioritizing education and research, you position yourself to make decisions that are well-informed and align with your long-term financial goals, ultimately leading to a more rewarding investment experience. Selecting the right companies to invest in is a critical aspect of building a successful investment portfolio. This process involves evaluating various criteria to identify companies that not only have strong financial health, but also possess a competitive market position. Financial health can be assessed by examining key metrics such as revenue growth, profit margins, debt levels, and cash flow stability. A company with a robust financial foundation is generally more resilient to economic downturns and better positioned to capitalize on growth opportunities. In addition to financial metrics, evaluating a company's market position is crucial. This includes understanding its competitive advantage, market share, and the potential for future growth within its industry. Companies that exhibit strong leadership, innovative products, and a clear vision for the future are often more likely to deliver sustainable returns to investors. By applying these criteria, investors can make more informed decisions, selecting companies that align with their investment goals and risk tolerance. Diversification also plays a fundamental role in reducing investment risk and enhancing potential returns. By spreading investments across a variety of sectors, industries, and asset classes, investors can mitigate the impact of poor performance in any single investment. Diversification is often described as the only free lunch in investing, as it allows investors to achieve a more stable and consistent return profile without sacrificing potential gains. This strategy helps cushion the effects of market volatility, as different asset classes and sectors may react differently to economic and geopolitical events. For instance, when stocks in a particular industry face challenges, investments in other sectors or asset classes might perform well, balancing the overall performance of the portfolio. By maintaining a diversified investment approach, investors can better manage risk while positioning themselves to take advantage of opportunities across the market spectrum. This balanced strategy not only contributes to achieving long-term financial goals, but also provides peace of mind through varying market conditions. Understanding dividend-paying companies is an essential aspect of investing, particularly for those seeking a steady income stream alongside potential capital appreciation. Dividends are regular payments made by a company to its shareholders, usually derived from profits. They represent a tangible return on investment and can serve as a reliable source of income, especially for retirees or investors looking for regular cash flow. Dividends can be paid in the form of cash or additional shares, depending on the company's policy and the investor's preference. The importance of dividends lies in their ability to provide stability during market fluctuations, as dividend-paying stocks tend to be less volatile than non-dividend-paying ones. Furthermore, companies that consistently pay and increase dividends often signal strong financial health and a commitment to returning value to shareholders. This makes them an attractive option for investors who value both income and growth potential. Identifying reliable dividend-paying companies involves evaluating several key factors. First, consider the company's dividend yield, which measures the annual dividend payment relative to the stock price. While a high yield might seem attractive, it's crucial to ensure that the company's dividends are sustainable. This means examining the payout ratio, which indicates the proportion of earnings paid out as dividends. A reasonable payout ratio suggests that the company retains enough earnings for reinvestment and growth while still rewarding shareholders. Additionally, look for companies with a history of stable or growing dividend payments over time, as this reflects financial strength and effective management. It's also important to consider the industry and economic conditions that might impact a company's ability to maintain or increase dividends. Companies in sectors with stable cash flows, such as utilities and consumer staples, often provide more reliable dividends compared to those in more cyclical industries. By focusing on these criteria, investors can select dividend-paying companies that not only offer attractive yields, but also align with their long-term investment strategies. Monitoring and adjusting your portfolio is an ongoing process that is crucial to maintaining a successful investment strategy. Regularly reviewing your investments allows you to stay informed about the performance of your holdings and the overall market trends. This process involves assessing whether the individual stocks, bonds, or other assets in your portfolio are meeting your expectations and contributing to your financial goals. Regular monitoring helps you identify any underperforming investments or changes in market conditions that might impact your portfolio's performance. It also provides an opportunity to reassess your initial assumptions and strategies in light of new information, ensuring that your investment approach remains aligned with your current financial situation and objectives. Through consistent oversight, you can make informed decisions about whether to hold, sell, or adjust particular investments, helping to optimize your portfolio's potential returns while managing risk effectively. Rebalancing your portfolio is another important aspect of maintaining its health and alignment with your investment strategy. Over time, the value of different assets within your portfolio will fluctuate due to market movements, causing your asset allocation to drift from its original target. Rebalancing involves realigning the proportions of assets in your portfolio to match your desired allocation, which can be based on your risk tolerance, investment goals, and time horizon. This may mean selling some assets that have performed well and buying others that have underperformed to restore balance. Rebalancing can be done at regular intervals, such as quarterly or annually, or in response to significant market changes. The key is to ensure that your portfolio remains diversified and aligned with your long-term goals, which can help you achieve consistent returns while mitigating risk. By regularly monitoring and rebalancing, you can maintain a disciplined investment approach that adapts to changing market conditions and continues to support your financial objectives. As we draw this enlightening episode of the Success Blueprints podcast show to a close, let's take a moment to recap the essential steps that can set the foundation for your journey into the stock market. We've navigated the intricate landscape of investments, beginning with understanding the stock market's vital role and how it operates as a cornerstone of wealth creation. From there, we delved into the importance of setting clear investment goals, tailored to your risk tolerance and investment horizon, which form the blueprint of a successful investment strategy. We explored the practical steps of getting started, emphasizing the importance of opening a brokerage account and the critical role of research and education. In selecting the right companies, we highlighted the criteria that help identify those with strong financial health and market resilience, while also underscoring the importance of diversification in managing risk. Understanding the significance of dividend-paying companies and the strategies for effective monitoring and rebalancing of your portfolio round out this comprehensive guide. These steps, when approached with diligence and foresight, can empower you to embark on a rewarding investment journey. As you continue to explore the world of investing, let this episode serve as a reminder of the importance of continuous learning and staying informed about the ever-changing market dynamics. The stock market is a dynamic environment, constantly influenced by economic shifts, technological advancements, and global events. Keeping abreast of these changes requires a commitment to lifelong learning, whether through financial news, expert analyses, or educational resources. This dedication not only enhances your understanding, but also equips you to make informed decisions that can adapt to new opportunities and challenges. Embrace the mindset of a learner, always curious and ready to adapt, as this will be your greatest asset in navigating the complexities of the market. Remember, investing is not just about financial growth, but also about personal growth, as you learn to manage risks, recognize trends, and seize opportunities. We extend our deepest gratitude to you, our valued listeners, for joining us on this insightful episode of the Success Blueprints podcast show. Your engagement and commitment to learning are what make this journey rewarding for us as well. As you set forth on your investment path, we leave you with a thought-provoking quote by the renowned investor Warren Buffett. The stock market is designed to transfer money from the active to the patient. Let patience and informed decision-making guide your investments, allowing you to build a future that aligns with your aspirations. Thank you for tuning in, and may your investment journey be both prosperous and fulfilling.